Welcome back to Digi Tutorials. Let's dive into this discussion on ratio analysis. Ratio analysis in finance involves calculating and interpreting financial ratios derived from a company's financial statements to assess its performance, health, and efficiency. These ratios are used for both internal and external comparisons, helping stakeholders like investors, analysts, and managers understand a company's strengths and weaknesses. Here's a more detailed breakdown of how ratio analysis is used. 1. Defining the purpose of ratio analysis. Performance tracking. By calculating and comparing ratios over time, analysts can identify trends and gauge how a company's financial health is changing. Comparative analysis. Ratio analysis allows for comparing a company's performance against its competitors or industry averages, revealing its position in the market. Financial health evaluation. Different types of ratios, liquidity, solvency, profitability, efficiency, provide insights into various aspects of a company's financial standing. Decision-making. The insights gained from ratio analysis can inform investment decisions, creditworthiness assessments, and managerial strategic planning. Key types of ratio analysis include liquidity ratios, which evaluate a company's ability to meet its short-term obligations, such as the current ratio and acid test ratio. Solvency ratios assess a company's ability to meet its long-term obligations, like the debt-to-equity ratio and interest coverage ratio. Profitability ratios measure a company's profitability and efficiency in generating profits, such as the gross profit margin, net profit margin, and return on equity. Efficiency ratios assess how effectively a company is using its assets to generate revenue, for example, the asset turnover ratio and inventory turnover ratio. Lastly, valuation ratios provide insights into the market's perception of a company's value, such as the price-to-earnings ratio and the market-to-book ratio. Steps for effective ratio analysis include identifying the purpose, which means determining what aspects of a company's financial health are being evaluated. Next, gather financial data by obtaining the necessary information from the company's financial statements, like the income statement, balance sheet, and cash flow statement. Then, calculate ratios by applying the appropriate formulas. After that, interpret the results by comparing the calculated ratios with industry benchmarks, historical performance, and competitor data. Finally, draw conclusions based on the ratio analysis to make informed judgments about the company's financial performance and make recommendations for future actions. Examples of financial ratios and their uses include the price-to-earnings ratio, which helps investors determine a company's stock valuation and assess its potential growth. The debt-to-equity ratio indicates a company's reliance on debt financing and its ability to handle debt obligations. The gross profit margin measures the percentage of revenue remaining after deducting the cost of goods sold, showing the profitability of sales. And the current ratio assesses a company's ability to meet its short-term liabilities with its current assets. By using ratio analysis effectively, financial professionals can gain valuable insights into a company's financial health, identify potential risks and opportunities, and make more informed financial decisions. Please don't forget to like, share, and subscribe for more video content. See you in our next session.